Welcome to Module 7, which is on pipeline development. It is one of the most exciting aspects of investments. It is about finding businesses that you are excited to invest in and to weld together a collection of these businesses in which you want to invest both your time and capital. Especially given the duration of your fund life, we will spend years working with these businesses. So, the selection process of finding these deals is critical. But what is also important is to ensure that you have a strategy to how you're selecting these deals. Building your pipeline of deals happens when you tap into your personal and professional networks. It happens when you're aware of what is happening in your markets and which companies are standing out. You want to hone your skills in identifying these businesses before they become known to everyone. Then you want to build the relationships with the entrepreneurs and with the management teams. You want to understand what is driving consumers' behavior in purchasing these products and these services. There's a great deal of more formal entrepreneurial activity that has been happening across the continent, especially in the last 5 years. Early stage businesses and tech businesses are attracting a lot more capital. There are many more accelerators and incubators on the continent. Let us also acknowledge the persistent data that shows that women led companies outperform when receiving capital. However, still are not receiving much capital. That is part of the reason you are here. So, as you build your pipeline, we hope you will be more cognizant of the value of inclusion. What does this mean? The potential to build your pipeline is both rich and diverse. We hope you will leave this module more aware of the process of pipeline development, assessment, and portfolio management that wraps around the excitement of finding and doing good deals. Welcome to the module on pipeline development. This is being recorded by Geetha Dharmaratnam. We start by talking about deals and transactions. What exactly is a deal or a transaction? It is the financing provided for usually private companies that investors believe to have had long-term growth potential. It takes the form of both cash or capital, monetary inputs, and technical or managerial expertise. There are four elements of this that we're going to discuss today. The first is that language matters. When you are developing your fund profile, you will present yourself and position yourself and pitch yourself to an entrepreneur in a way that is different to how you would do so with an investor. With an entrepreneur, you are building trust and you're building a relationship for them to feel comfortable engaging with you, accepting your capital, and being willing to work closely with you over a period of 3 to 5 years. You also want to think about, who do you want to be known as? Do you want to be known as a hands-on partner who is actively involved, or a passive investor who brings capital to the table and then steps back? A second aspect of what you want to think about when you're developing your deals is about value creation. Private equity is known for being far more than just capital. So you want to really fine tune what it is you bring as value to the companies that you're investing in. Are you bringing networks? Are you bringing sector expertise? Are you bringing certain relationships with banking organizations, for example? You want to think about these networks in how they can be helpful to your investee companies. The third thing here is about capacity building initiatives. Often they will be executives and management team members who are really looking to learn and grow. And so part of your value creation strategy might be the strengthening of the middle layer, perhaps, of management, or the institutionalization of these businesses. The third element is around relationship building. This is about proactively building relationships so that you become the go-to person. You are known as, if you want an investor who is going to seriously provide capital and help your business grow in this area, in this sector, this fund manager is the one to go to. And you want to do so within the space in the ecosystem that you want to occupy. And you want to be aware of how people are communicating with each other in that particular space of the ecosystem. Do avoid the temptation to be transactional, especially after you've raised the capital. It becomes quite tempting to just think about things in a cut and dried way. The reality is, investing is deeply personal. The fourth element of what we're going to talk about is proprietary versus preferred. While you want to build your pipeline from the ground up, meaning deal by deal, it is always seen as a good thing when you can find a business that is a proprietary deal for you, as in they're not talking to other investors, they're only talking to you. LPs particularly like that situation because it shows that you're building a strong relationship with the entrepreneur. Being a preferred fund manager is when the entrepreneur has got choices. They're talking to multiple people, but you are at the top of their list. So, what you want to do here is, as you build your pipeline from the ground up, you want to go deep into the sectors and the subsectors so that you can understand what is going on there. You want to have lots of good conversation with entrepreneurs on a regular basis, and you want to communicate what value you bring and to help these entrepreneurs understand that you are empathetic and really thinking about what it is that they need. There are multiple methods of sourcing deals. You want to begin your deal sourcing journey with a very clear objective. And that objective really is the objective that you have stated in your investment strategy as you have marketed your fund. You want to explore regular avenues for deals, but look at new avenues as well. We will discuss some of these new avenues. A good place to start is with your wish list. What subsectors align well with your wish list? What are the regions? What are the themes? The next is networks. Think about your personal networks. Think about your professional networks. Think about service providers, accounting firms, legal firms, for example. They are dealing with companies on a regular basis. If they know that you're out there and what you're potentially able to invest in, they become a good referral mechanism. There are some membership networks. It could be chambers, it could be the women's chamber, it could be the business chamber within your city. There are multiple membership networks that it helps to be a part of and to get the message you want to get out about your fund and how it is that you're investing so that deals get referred back into you. Today, there are many WhatsApp groups which have been set up. Some are sector specific, some are pan-regional. So think about which ones you want to be a member of and how you represent yourself within these WhatsApp groups so you are seen as a trustworthy, serious contender. Social media is increasingly becoming a popular way to understand what's going on. Entrepreneurs are actively signaling on social media as well. So this can also be a way of sourcing transactions. When it comes to relationships, your LPs are really important because they are also coming across transactions, and keeping those lines of communication open allow for them to transfer to refer deals onto you. You have your own personal networks. There'll be other investors who are looking for co-investors because the size of the deal may be larger than what they can meet. So they bring other investors with them, so you form a consortium. So you want to think about that and not always think about other investors as only competitors. Then there's angel and angel networks. So these are smaller investments that are made, usually by individuals. And here, many of these smaller deals can become the larger deals that you're looking for. And what's nice about this is you get in very early when valuations tend to be lower. Another way of looking at sourcing deals is through incubators or accelerators, a source of quality early stage companies. And you can find some quote unquote rough diamonds here. These are businesses just getting started, and often they're moving fast and trying to get things done in a different way to the norm. So it can be quite an exciting source of transactions. Some places have got very strong entrepreneurship programs linked with universities and colleges, and it can be a great way to build your profile, especially for graduate school students, for example, who are building their businesses, who are professionals and building their businesses whilst they're working in graduate programs. So it can be a source of future investments. Finally, I talked about co-investments, and this is when you come in as a syndicate. It allows you to really harness the wisdom, network skills, and the capital of a larger group. And this can be very attractive for entrepreneurs. There are some good practices that we want to raise to your attention. Relationship building with local business networks is essential. Business development is an important skill set, and you don't want to shortchange that. Take time, schedule time for this. Your deal sourcing strategy should be very clear and sustainable. It needs to be something you can continue doing on a regular basis. And you want to ensure that these businesses either meet your needs today or may meet your needs in the future. So you keep an eye on this from a longer time horizon perspective. We recommend you build a database where you're capturing information about all the transactions that are coming past you. It's easy to forget. And it'll allow you to do some analysis, which will show you if there are any biases that you're having. Perhaps what you thought was you were going to invest in 4 or 5 sectors, but your bias is leading you towards one sector. And being able to do that analysis on that database will start to show some of these issues. And you can then self-correct. You can also stay connected with entrepreneurs and business networks in a way that they have you at top of mind. They think about you quickly. Whenever anyone is thinking about raising capital, they know that you are somebody from whom they can raise capital. Some things for you to think about as a first-time manager and to be wary of is you want to approach an entrepreneur differently to how you would an intermediary. First impressions are really important. When you're approaching an LP, you may be in a sales pitch mode, but when you're talking to an entrepreneur, it's more helpful for them to understand from the beginning you are going to be in this with them and out to support their entrepreneurial journey. You also want to avoid approaching companies without clearly prioritizing your deal database. So you may find that if you're talking to 5 or 6 different entrepreneurs at the same time without prioritizing, your time and resource allocation can become problematic. So always think about the trade-offs and prioritize which deals you'd like to do sooner rather than later, and then spend more time on that. Don't cold drop conversations with entrepreneurs. It's tough. If you've started a conversation with an entrepreneur, do see it through, because most of them really appreciate being able to close that loop and to have a final answer. Even if that answer is no, constructive feedback is usually welcome. And do be wary of social media signaling, because there's some entrepreneurs who are extremely active on social media and sometimes tend to demonstrate that the approach that they're taking is about building the valuation of a company through visibility as opposed to what's going on in the company. So do be careful of social media signaling. It's worth taking a look at what the deals were that were done between 2015 and 2020. This data comes from the Africa Venture Capital Association, and you can see its current data. And what you can see is that the total value of reported African private equity deals was 21.7 billion between 2015 and 2020. The total volume of deals during that time period was 1,257. So these, once you break this down year by year, are not as many as you may think. However, you can see that often the share of PE deals is very much focused on in 4 regions. And within those 4 regions, the 4 main countries are South Africa, Kenya, Nigeria, and Egypt. So if you are investing there, you have more competition. If you're investing elsewhere, you have quite a lot of green fields. When you think about the funding and the sectors, this is the right-hand side of the deck right now, you can see which sectors have been attracting more capital. Financial services has been a significant one, followed by consumer discretionary, a lot of products focusing on the rise of the African consumer. Then you have industrials. Industrials are interesting because they may not always be immediately apparent. Industrials is often related to B2B transactions. So it might be a cement company that is using raw inputs from another company. So you don't have an individual consumer who's doing the consumption. It's actually business to business. This is on the rise in Africa today. And as you're thinking about your pipeline, you want to think about not just B2C, which is business to consumer, but also B2B, which is business to business. Information technology has been definitely on the rise, often as part of an integrated way of another sector. So it might be fintech instead of pure financial services. It might be ed tech instead of pure educational services like maybe a school. You have consumer staples. This is very much linked again to local consumption, utilities, which tend to be larger transactions, fewer but larger transactions, healthcare, even more important going forward, communication services, real estate materials, and energy. So you get a sense of where the deals have been going. And as you think about where you have identified your opportunity set to be, they may not fall neatly within these categories, and that's okay. But what you want to do is make sure that the deals as you're developing your pipeline are really aligning with the strategy that you sold to your LPs. There have been an explosion of innovation and technology hubs across Africa. Already by 2019, there were 618 tech hubs. And If you think about that, these hubs can be real hotbeds of innovation. And because of the co-working space that some of them provide and the incubator slash accelerator programs they provide, they can be a wonderful way to map into and link into early stage businesses. And they may not always be deals you want to do today, but keeping an eye, building those relationships, these entrepreneurs will remember you and will hopefully come back at a later point when they're more mature and ready for the kind of transactions you're looking at. However, if you're raising a venture capital fund, then you don't need to wait. These just become a great addition to you thinking about how to add into your deal pipeline. There are ways that you can go beyond the methods that we've just talked about. And it's helpful to have physical proximity, being physically on ground and being really aware of these hotspots of entrepreneurial activity. It helps you grow your pipeline even more. A deal scout is the kind of person who's increasingly being used, especially for smaller transactions or for tech-related transactions. A deal scout is an individual who has rich networks, deep domain or geographic expertise, and who are really passionate about building strong communities. These deal scouts can be founders, they can be graduates, they can be young professionals or startup operators, just anyone who is keen on pursuing investing as a career in the future. We've spoken previously about how you yourselves may already be deal scouts, and it can be a good way of building your track record before you've raised your fund. To do that, you need to look at the network of relationships, and that is to tap into first-degree networks of connections. That's your immediate friends, family, current and former colleagues. You can then start to move further out and look for connections where there are close ties between the startup or investment community and those which have a pulse on the up-and-coming entrepreneurs in the ecosystem. We're quite lucky because there are quite a few commentators in this space who are publishing significant amounts of data or who are active in social media when it comes to Africa. And so you want to just be aware of that. You've already created a WhatsApp group as a community here, and there's a flow of information coming through. Keep nurturing those because that adds to the network of relationships that can help you go beyond in developing your deal pipeline. When it comes to opportunities and challenges, underrepresented groups of founders get more visibility through scouts. And that includes female entrepreneurs. The second thing here is, however, scouts don't tend to be paid a basic salary, and sometimes there can be ethical issues around that. It really is about a fee that you can charge in terms of a referral. Scouts can also create dynamic networks that effectively keep founders close to the investors, hence getting closer to that proprietary deal flow that we were talking about earlier. However, founders can also be overburdened with scouts, and this can cause a time crunch when it comes to daily activities. So there are pros and cons when dealing with scouts, but it's up to you to decide how you want to incorporate that as you look to go beyond the usual in terms of developing your pipeline. You want to create also a deal funnel. And what that funnel is you start with a larger number of transactions. As you assess them, some will fall off and you're left with a fewer set of transactions that you'll take through a proper due diligence. But there's some background here that we wanted to raise to your attention. And this is about ensuring that you have a well-established process, not just for originating these transactions, but also evaluating them thoroughly and efficiently. And it will help you more quickly remove those transactions which are either low priority or considered unfit from the pipeline. So it increases your efficiency. There are three things here that I'm going to talk to you about. The first is database management. You can build something in Excel. There are tools today like Trello, Pipedrive, HubSpot. It helps you manage the information around the pipeline. You can do analytics as part of that, and they're quite cost efficient. The second aspect of that is you need to keep that database maintained, well maintained. You want to keep it up to date, you want to keep it relevant, and by giving access to your whole team, you are able to truly crowd in the wisdom and the networks of the entire team. And you then start that process of gathering information from the screening stage through selection and onwards through due diligence. The third aspect of this is the co-investor deal tracking. So you want to keep those relationships with potential co-investors. They can be friendly competitors, they can be LPs of yours. You want to have regular calls with them. Keep that information fresh and keep showing them transactions that you're coming across that you think might be of interest to them. Maybe it's something that you've passed on, but maybe of more interest or alignment with what someone else is looking for. This is a very deeply relationship driven space and sector. And part of showing your value add there, not just to your companies or to your LPs, is by also being part of the community of investors, of other fund managers. You also want to attend and be visible to companies who are on roadshows. As you create that deal funnel pipeline, what you can see here is you start with a larger universe of potential transaction. So for example, for argument's sake, let's say that this might be 500 plus companies. It's your wish list, it is your potentials, it's everything. And you have already established a criteria to assess the deals. You will quickly check and then it will reduce in number, because not all those deals in the larger universe will be aligned to your investment strategy. And you want to make sure that the pipeline is aligned to what your fund's defined investment strategy and impact objectives are. So this might mean that you go from 500 plus companies to about 200 to 300 with the early part of your screening process. Then you go into the early selection. You use the database and a tiered segmentation process. So you might say, okay, first choice for me are businesses which are in the capital city and are within a easily commutable distance to where the team are based. That might be high up on your segmentation. You want to identify what is important for you. As you do that, more deals will fall out of the pipeline and you will be left with, say, 100 or 150 businesses as part of the early selection. This is slicing and dicing. You then go into due diligence. After this, after you get the memos and the internal approvals, you can plan for on-ground due diligence. And it will be a much smaller number of transactions because these are your most promising deals. So you could start with 500 deals and end up really diligencing between 10 and 20. And then based on the due diligence that you do both offsite as well as on-site, you might end up doing between 8 to 15 investments, and that becomes your portfolio. So this funnel, this is something which you want to be very clear about the assessment process because it brings process, it brings consistency, it will help you become more efficient. And on top of that, the visibility and the learning is also going to be quite high because you'll soon find what you like, what you don't like, and it will help you source in a better way. As you vet and qualify these deals, there are 5 things that you want to take into consideration. The first is, as we said, does it fit with the strategy you agreed with investors? You do not want to deviate from the investment strategy. And the elements you want to look at are valuations. What is the valuation of the business? Does it make sense? Because if the valuation is too high at the point at entry, then it can be quite difficult to get a strong return because you need the valuation to be that much higher at the point that you want to exit. You want to look at the financial returns at the state of the company. You want to look at the impact and the expected impact you feel you can add. You want to look at the size of the transaction. Does it fit your strategy, the market, the sectors? Maybe gender plays a role if you are looking at it being a gender lens fund or having some element of gender lens investing. And you want to look at the stage of the transaction. Is it a startup? Is it early stage? Is it a growth business? And that too must align with the strategy you agreed with your investors. The second consideration is the time to build relationships. Relationship building is a process, and really responsive networks are built over time with trust, which means that you need to be visible and you need to really schedule time in your day, not once a week, but almost every day, where you are meeting with different groups of people. You want to be socially active in terms of making sure that you are seen to be visible within the business community, within the entrepreneurial community. Take that time to build strong relationships. The third consideration is due diligence. Here, what you're looking at is that critical component. How are you going to credibly assess the transactions? We've had an entire module on that, so we will not go further into it on this point. The fourth is what is the expected evidence of the growth of value in the company. Now, especially if you're fundraising, this consideration is important because you need to be able to articulate and explain through the investment committee process and to your LPs what you think this business is going to be able to do and how you're going to grow alpha in the future. The fifth consideration is about potential exit avenues. You want the deal to be able to provide suitable exits. Otherwise, you end up with a portfolio of businesses which you're excited about, which are doing well, but you're not returning money. And if you're not returning capital to your investors, it means you are not going to hit your hurdle and you are not going to get carry. There is a natural ebb and flow to the transactions that you're going to be investing in. And as you think about your pipeline, you do also want to very early on think about whether it is going to be easy and suitable to be able to get an exit route. Investment readiness really relates to whether these companies are ready to be assessed to be receiving capital from you. Many companies actually don't come ready for consideration. So you will end up having to get them ready to be considered by your investment committee. And so as a result, many deals suffer from issues which relate to compliance, governance, management gaps, legal structures, business model, and financial economics, lack of clarity. So we know that this is true, and it's pretty much true most parts of the world, especially if you're looking at SMEs. And so you need to just be prepared to get the entrepreneurs ready. And the way that you do that is we know that they have built their businesses to a certain level. That's before you have found them. They will often require you to work with them to become investment ready. And not many of them have joined incubators or accelerators. So they will need your hand holding. And you want to focus that hand holding to businesses which are promising to you because you're not general consultants. So you want to help those and spend the bulk of your time on those businesses that you think you can get exclusivity with and the ones that you think have a strong chance of making it through your own process. You can support them on the basics. That could be preparing a basic financial model, testing their business assumptions, assessing the depth and breadth of impact, thinking through their go-to-market strategy, and assessing the capital requirements. Very often, entrepreneurs aren't necessarily clear on even what the ask is, how much money they need, in what format, etc. And so this is one of the things you want to get into a deeper discussion with them and link to the due diligence you're doing. So that helps them get to investment readiness. Some things that you should expect is the lack of clarity of roles and responsibilities within the portfolio company, especially with entrepreneurs who have built the business over a period of time, and you are going to be looking to institutionalize the business, that you might find a CEO who is also signing off on all procurement, who is also the head of HR and head of operations. So expect that lack of clarity. You want to also ensure that there's an alignment between those who own the company and those who are running the business. So this is the difference between professional management and family ownership. It is very normal to structure part of your transaction to go in as part of the capital pledged by the professional management because it gives them more skin in the game and it will help them feel like the more they do well, the more they will be rewarded. And it's about that alignment of incentives between them, the company and you and your LPs. And you should also expect a real lack of institutionalization of processes, especially the accounting process. So getting an MIS system in place so that there is a technology solution is something you should really expect to do. The good news is in 2021, the costs of this have significantly come down compared to even where they were like 3 or 5 years ago. So try and get them weeded off Excel. You would be surprised how many businesses are still running the bulk of them themselves on Excel. When building your knowledge base, you want to start early. This is the deeper knowledge around the sectors, especially the regions and the themes of your strategy. For early stage funds, pipeline building really involves a critical component of developing the technical and advisory base of knowledge within the investment team. But even for later stage funds, it's quite similar. So if we look at key sectors, you should dig beneath the sector to understand the dynamics. So saying you're investing in education is not sufficient. Try and think through what the average age of the population is. How does that translate in terms of the likelihood of students needing schools, and whether they're going to need technical schools, whether they're going to need vocational schools, and whether they're going to need fewer or more K-12 schools. So think about dynamics underpinning the sector itself. Think through the value chain of the sectors. In Africa is a place where often you need to build a certain part of the value chain. And so you may be investing in a healthcare business, but you also need to think about the route to market. So you might need to think about the logistics of getting people to the healthcare facility or the healthcare manufacturing plant to the point of sales. You also want to think about how sector risks can be mitigated. There are very specific risks from a sector by sector perspective, right? And this is what you want to also include as you're building your knowledge around that sector. The fourth thing here is how can you replicate value creation activities? So for example, if you are investing in education, and one of the key issues in education is the lack of training and ongoing training for teachers. If you are able to come up with a solution to have a online training program which allows these teachers to connect with various programs around the world, you can replicate that quite easily with the next school you invest in and the next school you invest in. So the replicability allows you to standardize and move much faster and build real depth into the value creation that you're developing. The second aspect here, as you build your knowledge base, is the key regions. We need to get away from general Africa analysis because the sectors, the regions we're investing in are a lot more detailed and nuanced. And we know that this continent is deeply diverse. So you want to think about the region and the country dynamics, and you want to think about how general trends are materializing in your region and country, and therefore affecting the opportunities to invest. As you do that, you also want to think about the base investment case in terms of population, infrastructure, governance, enabling conditions, because it can really differ greatly between one city and another in one country or between one country and another. And bringing these elements really shows investors and it shows entrepreneurs that you are really understanding that investment case that you are saying that is there, and increases the trust and the confidence that you can deliver against it. The third thing here is the key themes. It's not region, it's not sector, it's something else. These are themes which are uniting sectors or uniting regions. And an example could be, are there macroeconomic tailwinds that are positively affecting your investment case? Many of the countries in our continent have been going through that, where there's been reform. And as a result, it is removing a lot of the hurdles that were there before. You also want to think about, are regulations coming into place, which are opening opportunities. Privatization is a good example. Another example is the regulations which are governing increased need for even insurance services. Africa has got a very low insurance penetration. It is less than 4% currently. And so if regulations are coming in requiring people to get insurance, then that regulation is going to increasingly open up the market. So think about these key themes. The third is around technology. It is very easy to, on the surface, talk about an African technology solution, but the strongest reactions or the strongest outcomes have really come where technology has been implemented into brick and mortar solutions. So you also want to think about how technology is playing a role in your investment case, and you need to have a position on that. The final thing is, what is the unique perspective you can bring? What are the insights that you have? You want to bring these out as part of the key themes as you are building your knowledge base. As you put this through, traditionally portfolio management is after you've invested, you have all these portfolio companies and you're thinking about this. But what I'm talking to you here is about building a target portfolio, which means you start with the portfolio you want and you replace it with the portfolio that you eventually invest in. What that means is you start with the intended investments, your pipeline, assumed composite deals, and as you invest, you update the Excel model. It's always focused on the latest data, but it is inclusive of where and all that you're expecting to manifest in your final performance. It allows you to really keep a comprehensive view and to know whether you can land this plane on the runway in the way that you expect to. Think about certain variables. This include exit scenarios, what is the currency volatility, and the performance of the businesses. It's generally a four-step process because it also allows you to keep an eye on the capital you have and keep asking yourself, what's the best way I can utilize this capital? Start with the deals you like. It needs to be your credible wish list and based on your investment strategy. So if you are looking at investing in climate change technologies, but a wonderful deal comes by, which is a business selling biscuits, if it's not in your investment strategy, it's not credible. You might like the deal, but it's not credible. Then you want to think about step two, which are the deals that you're working on. You've been nurturing, you've been incubating, you've been talking to these entrepreneurs. They've been talking to you. You've had sometimes these relationships go back years. So you want to bring those in and you'll prioritize those because you're more likely to do those deals. There'll be opportunistic deals that also flash in and out, especially once word gets out that you are in the market and you have capital. Deals will come to you, but be judicious, be careful about which of these you wish to invest in, because these unexpected transactions can sometimes start to get very interesting and you then significantly deviate from what your strategy is. So think about that carefully. The fourth thing here is it is very common to reinvest in your existing transactions as they grow. So you want to maintain some capital for follow-on investments, which you can then compound within the companies that you feel are doing well. As you think about managing information, you also want to think about how you're sharing your pipeline internally and externally. There is confidentiality to be respected in the entirety of your investment portfolio. It's particularly critical when you're building your pipeline because this is when you are expecting entrepreneurs to share confidential information about the actual performance and the future strategy of their companies. They will be very anxious because if this information leaks, it can harm their business activities, it can alert competitors to their plans. So you want to be very careful because you may inadvertently let information leak. There are two things you want to look at. One is internal, the other is external. Internally, there are two groups in particular. One is other team members. You want to ensure that internal confidentiality is maintained through processes, which means having agreements in place, making sure that they are processes that will support the kind of culture that you wish to have of confidentiality. Use code names for companies so that whether you're inside the office or outside the office, if you're using that code name, no one will know what you're talking about specifically. It helps. The second group is the investment committee. And here they need to strictly maintain confidentiality. And very importantly, they need to maintain the chain of communication between the investment committee and the deal team so that it is the deal team who's engaging with the portfolio company or the potential pipeline company and not the IC. And you then are able to have a very honest, rigorous debate at the investment committee, but the deal team are clear on how they want to run the fund and how they want to run the investment. From an external perspective, the people who are most likely going to see your pipeline are your limited partners. You want to share what you're obliged to, and you agree that at the point at which you are negotiating the terms of your fund. But you also want to reinforce confidentiality through the use of code names and reminders around the fact that this needs to be kept highly confidential. It's interesting from a psychological perspective what those reminders are able to accomplish. The investment committee is not just there from a governance perspective, but they really can be very good in terms of strengthening the assessment of transactions through the review of the pipeline. So you can look at what the IC's role is. The governance is key. And this is to ensure that the fund's assets are being invested in accordance with the agreed investment policy. They will also look at the LPGP relationship. They help the fund make decisions about the deal selection, ultimately authorizing the final process for due diligence and budgeting. Then you've got the depth and breadth of experience that they bring. A well-balanced investment committee will bring relevant expertise, complementarity to the investment strategy of the fund. Sometimes they'll bring very deep or multi-class experience. All of that is helpful. So when you run your pipeline through your investment committee on a periodic basis, they're able to bring that depth and breadth of expertise to help you strengthen your assessment of the pipeline. There's pressure testing. This is where they're checking to see whether your assumptions are really holding water. Finally, there's the macro assessment. So this is very high level, and it is related to the tactical asset allocation. So when assessing the pipeline, they can help you plan responses to potential macroeconomic or financial market events. This can be related to risk, budgeting, and portfolio construction. So this is another dimension to the investment committee and the role they can play in assessing your pipeline. We've covered a lot today, and this really is one of the most exciting elements of being an investor. Developing your pipeline, finding transactions, falling in love with these transactions, going through the rigor of testing them, finally investing in these businesses. And so there are quite a few tips that I want to share with you. The first is keep track of what you turn down, because those deals may not be a great fit today, but they could be a great fit later. And this pipeline will give you information to inform future follow-ups. Investors also love to see this because they get a better sense of what your networks are really like, as opposed to just judging it based on the few deals that you will eventually do relative to the very many deals you will have assessed. The second point here is you should keep things confidential and protect your deals, because you do not want entrepreneurs to lose their trust in you and be reluctant to share information with you. Third is be aware of social media signaling. This is really not a proxy for a company's growth or success. It's good to get the accolades, but real value is observed in the interaction with the entrepreneurs, and that is usually done offline. And so, with social media signaling, you want to be able to differentiate between those who are advertising versus those who are being rewarded for the provision of good services, strong products, etc. The fourth point here is having a proprietary deal can be very hard to truly get. So the more you build your business network on ground, you are able to get ahead of the curve. The constant process of building your firm's profile will help you become the go-to investor in a particular area or for a particular theme. And that helps to increase the proprietary nature of these transactions, because then these companies are only talking to you and not to a number of other investors. You want to maintain relationships and schedule time for the maintenance of relationships, because there is a thin line between actively mentoring entrepreneurs you expect to invest in and spending time on transactions that you may not eventually do. So that prioritization of time and resources, keep managing that, but do make sure that you do prioritize the time needed to maintain relationships. The sixth point is you need to avoid chasing common deals. There's some deals that just get shopped around. So you want to focus and remember the market gap you identified, and be careful to not chase the same deals. LPs note if you really divulge from the original strategy that you had sold to them. So make sure that you stay aligned. The seventh point is be careful not to overpromise or to undersell, because on one hand, it can be very hard to identify or predict real value. But on the other hand, you don't want to underestimate the value add of what you are going to bring with your unique value creation during portfolio management. You will arrive at that destination during the conversations, the multiple conversations and engagements, formally and informally, with the companies. But you want to start this relationship from a position of trust and honesty, with a little bit of salesmanship. The next point here is time management. And again, your time will get eaten up very quickly. So rigorously manage and defend your time. It gets busy when you're finding new deals and strengthening a new deal as you're taking it through the investment process, as you're getting it investment ready. And then as you do deals, it gets busy to portfolio manage. And you're having to do all of these at the same time. So just be very careful with your time management. Finally, there is the issue of reality. Entrepreneurs talk to each other. So please be kind and respectful to the entrepreneur's time and efforts, and share constructive feedback. It is never a bad thing. If you can refer them to other investors, entrepreneurs remember this, and as they talk to each other, you get a reputation for not just being somebody who can bring capital, but somebody who brings real value. And one entrepreneur giving that advice to another entrepreneur is incredibly powerful. I hope that you've had a chance throughout this process during this module to really think about the nuances of building your pipeline. And I hope that by the time you finish this module, you will be going back to look at your pipeline and recognizing it is a living thing that you will adjust from time to time. And I wish you luck.